how 1099 loans actually work. A lot of self-employed people hear the term 1099 loan, but honestly still have no idea how these loans actually work behind the scenes. And I think that confusion causes a lot of people to assume they can't qualify, when in reality, they may be much closer than they actually realize. Hey guys, this is Sal Basio with Mortgage Universe on YouTube. And one thing I've noticed over and over again is this. Self-employed borrowers usually assume the mortgage process is automatically going to be a disaster, especially if they write a lot off, own businesses, have fluctuating income, or don't show huge taxable income on tax returns. And to be fair, conventional lending can become difficult in those situations, most of the time are, because traditional underwriting isn't heavily focused on net taxable income after deductions. That's the key thing people miss. So let's say somebody makes $250,000 gross income, but after business write-offs, expenses, depreciation, deductions, maybe their tax returns only show a much smaller usable income number. Now suddenly on paper, they look like they make far less money than they actually do in real life. And this is exactly where 1099 loans come into the picture. Because instead of hyper-analyzing giant complicated tax returns, many 1099 programs focus much more heavily on borrowers' actual 1099 income. That's the major shift. The lender is essentially saying, let's look more directly at the income being generated instead of only the final taxable number after all the deductions. Now, every lender handles this differently, but generally speaking, many 1099 programs will analyze total 1099 earnings, consistency of deposits, business stability, time receiving 1099 income, usually they want 2 years, reserves, and just your general credit profile. And in a lot of cases, lenders also want to verify the income itself is legitimate and stable. So sometimes they'll ask for like a VOE from the employer, or company paying the 1099 income, and even just a simple email verifying some things, pay stubs or earning statements that match up directly against the 1099s themselves. That's a really important part of the loan product. The lender is still validating consistency and stability. They're just doing it differently than a traditional full doc loan. And believe it or not, these rates are not much higher than your conventional rates. Maybe a little bit, but I just did one. Right now, the par rate on a conventional loan is 6.25. I just did one at a 6.75. So we're talking only a 0.5% higher in rate to avoid that wreck, basically, right? You have these options. And then, of course, they'll apply an expense factor. So instead of taking 100% of the income, they might just take a 10%. Most of the 1099 lenders that I have will only basically shave off 10%, so we're still able to use 90% of your income. If we can get a letter from either a CPA, or if we can get a letter from your employer that says you don't have any business expenses, well, then they can bring that right back to 100%. So that's another huge piece people don't understand. The lender doesn't assume 100% of your gross 1099 income is usable, but we will ask that, the lender will ask questions about it. Self-employed borrowers still have business expenses, in many cases, but sometimes not. So that's why we get that verification. Many lenders apply some type of expense ratio or reduction, factor depending on the industry, the business type, documentation strength, just general lender guidelines. For example, some lenders, like I mentioned, may use 90% of 1099 income, or sometimes 70%, sometimes even lower depending on the scenario. But a lot of the 1099 lenders these days just has an automatic 10% ratio, which is really nice. So if you're 1099 employed, I typically like taking those loans on. They're actually a lot easier most of the time than doing a bank statement loan, which is a different loan product we'll talk about in another video. But anyway, this is why lender selection matters so much in the non-QM world, because two lenders can look at the exact same borrower completely differently. One lender, may approve it pretty easily. The loan that I just closed today, actually, it was kind of a nightmare. I had to go back and forth with the employer several times, several emails, updating the VOE, and it was a little difficult, but we got it done. And by the way, if you guys are into conversations like this, self-employed mortgages, DSCR loans, investing, leverage, knowing how lending actually works behind the scenes, definitely follow along. Go ahead and click the like and subscribe button. I'm definitely going to be doing more of these videos, because I generally think a lot of self-employed people still don't realize how many options actually exist right now. Now, obviously, these loans, like I said, still have underwriting. This isn't some random, easy money lending. Credit matters, reserves matter, payment history matters, cash flow matters. Honestly, reserves are a bigger deal on 1099 loans than most people realize. Lenders love seeing liquidity, on self-employed files in general, because reserves help show stability, especially when income fluctuates month to month. And another thing borrowers underestimate, is consistency. If somebody suddenly became self-employed 3 months ago, that's a very different file than somebody who's been receiving strong 1099 income consistently for multiple years. History definitely matters. Excuse me. And what's interesting is many self-employed borrowers actually make excellent mortgage clients once you structure the file correctly. So strong earners, strong liquidity, high credit scores, entrepreneurial mindset. The issue usually isn't lack of financial strength. The issue is trying to force a modern self-employed borrower into an old traditional underwriting box. That's the disconnect, because the workforce changed dramatically. More entrepreneurs, more freelancers, more commission income, more creators, more consultants, more independent contractors. The economy itself became more flexible, and non-QM lending, including 1099 programs, evolved directly out of that shift. So that's why I keep saying a lot of the self-employed borrowers are far more mortgageable than they actually think. They're often just looking at the wrong loan structure entirely. And once people finally understand how these programs work, the conversation changes from "I probably can't qualify" to "wait, there may actually be a strategy here."